So it's back to the markets, and of course we're taking a look at some of the issues that have come up, including the release of the February inflation and the impact it's expected to have on the market, if any. Robert Omotunde, who's the head of research at AfriInvest, joins me now. Robert, good morning. Thank you so much for coming on the program with me. So there's quite a lot that's already been said online, as I said, and offline. For you, I already know AfriInvest had actually predicted that based on the base effect, would actually see inflation numbers coming in lower. So these numbers didn't come in as a surprise.
Well, not as a surprise because it came in lower as expected, but the magnitude, of the drop in inflation was a surprise to us. The reason is because we were not expecting that on a month-to-month basis, inflation would come in as high as 1.5%, which we had. So if you compare what the month-to-month change was in December relative to January, it was like 1.0%, but between January and February, we had 1.5%, which for us is disturbing because it means that we have further pressures coming in on inflation numbers, particularly from the food index.
But then you said it was a guided commencement of a base effect. So literally, most analysts had actually expected something like this to happen.
Yes, we expected. I mean, our own forecast for inflation figure for February was around 17.3, and we saw it at 17.8%, which is why I said we were not expecting that we're going to have that much pressure on a month-on-month basis. And it may be noteworthy to say that this pressure came mostly from the food index, which we saw rising higher than expected for the month of February. Slight increase on the imported inflation, and of course we even had a drop in what you could call the energy index of the CPI, which constitutes water, gas, electricity, other fuels. But I mean, we saw a moderation in that from as high as 27%, year on year, to about 20% year on year in terms of the energy index component of the CPI. So the food index was majorly a constituent to that pressure also.
I know, Robert, you and your team have sat down and dissected these numbers and taken a look at the effects it might likely have on the market. Let's start with the fixed income segment of the market. Today, the Debt Management Office holds its last auction for FGN bonds for the first quarter. And then the Central Bank of Nigeria will also be having a treasury bill sale, same amount, matures tomorrow. So there's so much liquidity in the system. And then you have these numbers that you're looking at.
Well, maybe there's no so much of liquidity in the system. We have a lot of demand in the system that will be competing for the liquidity that we have. Remember that on Monday there was an OMO auction, by the central bank, which of course I'm not sure that auction was largely fueled because of the crazy rate at which people were bidding. So today we are seeing a situation where there is going to be a treasury bill auction, and of course there'll be an auction from the Debt Management Office. For us, we do not think that investors are expecting, are going to significantly shift on the basis of the inflation figure that we have seen, because like we said, it's largely expected that inflation was going to come in, lower because of the base effect, not necessarily that the pressure in the system in terms of price volatility is moderating. In fact, we've seen it worse, for the month. You could see a year-on-year reduction, but from the month-on-month basis, if you're going to see inflation as a stock variable, like economists would say it means that the life of Nigerians are even worse with this inflation figure that we're seeing right now. It's coming as a surprise to you. Okay, so let me explain. So in economics, we always talk about stock and flow variables. So inflation is a flow variable that we measure on a year-on-year basis. So because we had an increase or a hike in electricity tariff in February 2016, so we saw inflation figure in 2017 February coming in lower because there was a high base effect, that is not playing out again in 2017. But in fact, in terms of the pressure that consumers are facing, they're having more pressure now because you've seen figures coming even higher than they were in February 2016 when that electricity hike came in. And of course, we're still going to see further base effect playing out by May which of course was when we moved to liberalization of the downstream oil and gas. And we see another one in June when we had a devaluation of the currency. So the base effect will keep playing out. But of immense note to us is the fact that we're not seeing the sort of moderation which we expect. Maybe for the month of February it was expected because it seems to be the peak of the dry season, you know, when you look at it. So but in March we are not also, because of the new pressure we have seen, you know, in fact our projection is that inflation might still moderate to as, you know, low as 17.3%.
But then it
by
might
March.
It might not reflect in the average Nigerian's pocket, because
Exactly.
everybody keeps asking. So you find on paper, okay, you hear that inflation is moderating, but you talked about the fact that food prices actually contributed to that increase.
Exactly.
Even though we saw a slowing down in core inflation as well as the urban and rural index. But the most important, which is food, rose astronomically, which was the first in a very long time that we've seen.
True.
So it's not in my pocket. It's not on my table either.
Yeah, it's just a mathematical improvement. If you can put it that way.
Those numbers really do not help Nigerians a lot, especially since you're hoping to get the best out of the system. So we've talked about the fixed income segment of the market. How about the equity side and the forex?
Well, for the equities segment, I think the sentiment that we've seen play out in recent past will still continue to play out. You know, so inflation is at 17.8% now. Investors should naturally want to tilt towards playing equities for a higher gain, but not with the kind of high yield environment that we have. If you look at instruments of shorter term to maturity, whether you're looking at treasury bills or you're looking at bonds with maybe 1 to 2 years term to maturity, you could get as high as 18%, you know, in some cases 19% of yields. So, and with the pressure and the volatility that is characteristic of an equities market, you know, you're not likely going to see a movement of investors towards playing the equities market. So you're still going to see more of activities within the fixed income segment of the market. For forex, well, the central bank is trying all it could to ensure that the liquidity in the system is improved and to ensure that the spread between the parallel market and the official market is indeed close. But the point is that, yes, that is going to help in the short term, you know, but again, if you're going to marry the quantum of demand that we have in the system relative to the bit that the central bank is trying to address, which is the PTA, BTA, medical, you know, and all the travel allowances, it's, I won't say a drop in the ocean, but it's like about 20%. You know, of the market, you know, segment.
But then it gives a positive signal to the market that this is what the regulator is doing and this is what it is ready to do in the coming days, which is what the market has basically been looking for.
Yeah, but I think more than what you just mentioned, what the market is indeed looking for, it's a system or a framework that allows for flexibility, that allows you to be able to predict what the exchange rate. For now, we don't have a basis for us to forecast what the exchange rate movement will look like. All we know is that from the spread between the parallel and interbank, there is a devaluation in the horizon. You know, we can predict what inflation figure will be, but not for FX because there is no market-friendly system. I think that's what the regulator should be looking at.
All right, Robert, let's anchor this conversation here for now. Thank you so much for coming on the program. Robert Omotunde, Head of Research at AfriInvest West Africa. Business Morning is back after now. Stay with us.